Hi everyone, my name is Ashley Emert and I did my case presentation over Chapter 3, Financial Statements Analysis and Financial Ratios. Chapter 3's closing case is titled Ratios in Financial Planning at East Coast Yachts. The passage explains how, in large part because of its own planning, East Coast Yachts has experienced difficulty in the past financing its growth plan. Larissa has assigned Dan to find out exactly how East Coast Yachts is performing relative to its industry, as well as to find out what future financing is necessary to fund its growth plan. Question 1 states that East Coast Yachts uses a small percentage of preferred stock as a source of financing. When calculating the ratios for this company, should preferred stock be included in total equity? The answer is yes, preferred stock should be included in total equity. Shares of preferred stock represent an ownership stake in the company, usually issued with fixed dividend payouts paid monthly or yearly. Such dividends must be paid before any dividends are considered for shareholders. Preferred stock has the ability to appreciate in price. Owners of preferred stock have limited rights, usually not including voting rights. It is important to note that debt takes precedent over all forms of equity. So to speak, if East Coast Yachts declared bankruptcy, all debts must be paid off before any equity can be restored. Question 2 asks that you calculate all of the ratios listed in the industry table for East Coast Yachts. Each of these ratios belongs to one of the 4 areas of classification: liquidity, solvency, turnover, or return. Liquidity ratios measure a company's ability to pay off its short-term liabilities. The current ratio is a measure of a company's short-term liquidity. To calculate the current ratio, current assets are divided by current liabilities. East Coast Yachts has a current ratio of 1.006. A quick ratio measures a company's short-term liquidity against its short-term obligations. To calculate a quick ratio, inventory is subtracted from current assets. That number is then divided by current liabilities. East Coast Yachts has a quick ratio of 0.61. Solvency ratios consider all debts of all maturities to all creditors. The total debt ratio measures the amount of leverage used by a company in terms of total debt to total assets. To calculate, total equity is subtracted from total assets. That number is then divided by total assets. East Coast Yachts' total debt ratio equals 0.547. The debt to equity ratio measures how much of a company is owned by creditors compared to how much shareholder equity is held by the company. East Coast Yachts' debt to equity ratio is 1.207. The equity multiplier measures how much of a company's assets are financed through stockholders' equity. East Coast Yachts' debt to equity ratio equals 2.207. The interest coverage ratio measures how well a company has its inventory obligations covered. East Coast Yachts' interest coverage ratio equals 7.02 in generating sales or revenue. East Coast Yachts has total asset turnover of 1.519. For every dollar in assets, $1.52 is generated in sales. Receivables turnover measures the number of times the average balance of accounts receivable is collected during the period. East Coast Yachts' receivable is 32.737. Inventory turnover measures how fast a company can sell products. East Coast Yachts' inventory turnover is 21.901. Return ratios measure how well a company uses investments to generate returns for a company and its shareholders. Profit margin measures the extent by which selling price covers all expenses. East Coast Yachts' profit margin is 8.121%. Return on assets is a measure of profit per dollar of assets. East Coast Yachts' return on assets is 12.332%. Return on equity is a measure of how stockholders face during the year. East Coast Yachts' return on equity is 27.221%. The first part of question 3 asks that you compare the performance of East Coast Yachts to the industry as a whole. East Coast Yachts' current ratio is less than the industry average. This suggests that East Coast Yachts is not sufficiently placed to pay its short-term debts. To combat this challenge, East Coast Yachts should focus on increasing its assets or decreasing its current liabilities. East Coast Yachts' quick ratio is also less than the industry average. This suggests that East Coast Yachts may not have enough liquid assets to fully cover its current liabilities within a shorter time and creates greater risk. East Coast Yachts should once again focus on either increasing its assets or decreasing its current liabilities. East Coast Yachts debt ratio of 0.54 suggests that East Coast Yachts is financially solid and more financially solid than industry competitors. This lowers its chance of insolvency. East Coast Yachts debt is positive per the industry standards. East Coast Yachts equity multiplier is higher than the industry average, suggesting that they may have higher financial leverage while incurring excessive debt to finance its assets. East Coast Yachts should focus on limiting new debt as much as possible while paying off debt already incurred. East Coast Yachts interest coverage ratio is positive as per industry standards, signifying that East Coast Yachts should be well versed to cover its interest expenses with its available earnings. East Coast Yachts total asset turnover is greater than the industry average, which signifies that East Coast Yachts generates more revenues from its assets than its competitors. This also suggests that the company operates more efficiently than its competitors and is making good use of its capital. East Coast Yachts receivables turnover is positive as per industry standards, indicating a high efficiency in collecting receivables and managing credit extended to its customers, as well as indicating strong cash flows. East Coast Yachts inventory turnover is positive as per industry standards. This suggests that the company is selling products quickly and that there's considerable demand. An inventory turnover ratio that's too high can cause a company to need to replenish inventory constantly, possibly leading to a stock out. Because East Coast Yachts has faced challenges meeting additional demand in the past, the company should consider increasing its inventory, decreasing this possibility of not being able to meet demands. East Coast Yachts' profit margin is positive as per industry standards, indicating that they are more efficient at converting sales into profit than industry competitors. To improve profit margin, East Coast Yachts can improve its management efficiency and planning effectiveness. Strong pricing strategies can also be used to improve profit margin, such as controlling its costs or providing goods at a price significantly higher than its costs. East Coast Yachts ROA is positive per industry standards, indicating that they are efficient at using their assets to generate revenue. Because East Coast Yachts ROA is greater than the industry average, you can assume the company is asset efficient and able to earn more money with a smaller investment than their competitors. The second part of question 3 asks that you create an inventory ratio calculated as inventory divided by current liabilities. The text says, how would you state this ratio? How does East Coast Yachts compare to the industry average for this ratio? The inventory ratio is a measure of liquidity, aiding in assessing whether a company has enough easily liquidated assets or inventory to meet its short-term financial obligations or current liabilities, without relying heavily on external sources of funding. East Coast Yachts' inventory ratio of 0.396 is less than the industry average, suggesting that East Coast Yachts' inventory is relatively small compared to its current liabilities. Although a low inventory level can offer advantages such as cost savings and efficient resource allocation, it also comes with great risks. Maintaining very low inventory levels can increase the risk of stockouts where the company is unable to meet customer demands in a timely manner, which has been the case for this company in the past. East Coast Yachts should focus on increasing inventory levels by increasing its economies of scale. Purchasing larger quantities of inventory often leads to cost savings per unit as well. An inventory management software should be implemented to help track inventory levels, forecast demand, and automate the reordering process.